All right, we are at about 3 minutes past the hour, so why don't we go ahead and get started. Good morning, good afternoon, or good evening, everybody. My name is Eugene Turk. I'm the Vice President of Business Development at Align, and I want to welcome you to our monthly coach webinar for March 2022. Hope everyone is doing well, and thanks so much for joining us today. We are thrilled to have Greg Crabtree with a presentation on simple numbers, pricing strategy, and inflation management. For those of you who may not be familiar with Greg or have never played a round of golf with him, he is a speaker, author, entrepreneur, and financial expert. He originally founded his own firm, Crabtree, Rowe, and Berger, to focus on helping entrepreneurs build their economic engine. After being named to the Inc. 5000 list for 2019, Greg's firm merged with Carr, Riggs, and Ingram, CPAs and advisors, a top 20 US accounting firm, to help broaden their impact in the entrepreneurial community. In 2011, Greg wrote his first book called Simple Numbers, Straight Talk, Big Profits, in which he shared his core principles on how to turn your business into a wealth building engine. In 2014, he contributed a chapter to Vern Harnish's book, Scaling Up, on how to improve profits through labor efficiency. More recently, just a few years ago, he released his second book, Simple Numbers 2.0, Rules for Smart Scaling. He is a frequent speaker to groups like EO, Scaling Up, and many mastermind groups, and he's presented in more than 15 countries. He is also the chair of the EO at Wharton Executive Education Program for the last 5 years. And I understand we'll be launching a new executive education program for EO, the Entrepreneurs Organization, sometime this year, called Functional Finance for Entrepreneurs, that will hopefully teach EO members the basics of understanding their financials. So we are honored to have Greg present for us this month. As always, just one administrative matter. We want this to be an educational and informational for all of you as possible. Please feel free to pose any questions that you might have using the chat feature, and we will direct those to Greg at the conclusion of his presentation. Thank you all again for attending this month's Align Coach webinar, and I will now turn the microphone over to Greg.
Yeah, thanks, Eugene. Yeah, I appreciate it. Thanks for the opportunity to present to you guys. The topic, of inflation management and pricing strategy has been a really hot topic, for us of late. And so I think everybody will find that this has been a pretty timely thing. A couple of things that I want to start off with is essentially kind of setting the table of what we see. So in our practice, so we're not a local practice. When the firm that I built over the years, and really this was driven largely by my experience in EO, is just changing my where, not my share. I'm not trying to be the biggest player in our local market. We decided it was much bigger to have a smaller share of a global market and have clients anywhere, and we literally have clients all over the world. Which is kind of nice. I always like to say, when you as a professional advisor, when you work in your hometown, you're a local whatever. When you leave town, you're an expert. So it's kind of fun to be an expert, from that. But the nice thing is it gives us a picture of what's happening in the economy. And so think about it like this: no matter where you're at in the world, how much does the government know about what you did in your business performance in 2021? Now we're already into March, almost at the end of March. What do they know about 2021? In the US, the answer is nothing. In Canada, the answer is nothing. In Australia, the answer is nothing. So those are the three most dominant countries that we have clients in. There may be some countries around the world that you're required to provide more statistical business information, but I've not run across it, and I think there are some. But essentially, this is the problem, because if you really look at it, there should be roughly twice as many public companies today as there were 20 years ago. There's actually been probably as many companies go private as gone public in the last 20 years, largely because complexities of the public market, but most secondarily, you don't need to go public to get liquidity. I mean, the rise of this layer of equity between public markets and private markets of private equity money has created essentially a level playing field that our clients who've gone through sale transactions in the last 10 years, we're seeing essentially the same price between a private equity deal, versus a public company deal in most cases. In the old adage of the private equity guys are going to try to buy 40% of your company and then steal the rest, that just hadn't really been the norm. I mean, they actually are very competitive. They'll buy 100% of the business, in some of those cases. And so what we've seen is this change of the marketplace, to where really I believe the private companies are the dominant part of the U.S. economy. I would say of our clients we deal with in Canada, same thing. There's certainly some large companies in Australia that might drive that market, but the entrepreneur market in Zeal in Australia, our clients down there are quite active as well. And I think the problem is the government doesn't have a way of managing this because the data is not public. And so what we've started doing is we do this for our U.S. clients, but I think it gives you the indications that we get from our calls that we do with our Canadian and Australian clients. I think in every developed economy, this is going to be a fairly, consistent result. The economy did far better in COVID, regardless of government programs, than we basically thought. Yes, there are businesses that had particularly challenging environments. If you're a restaurant business that had forced closure, anybody that was in, if you were in the events business and had restrictions on gatherings and those things, some of those businesses struggled. But realistically, and I'll show you the data from our 100 company model here in a second, it did far better. And excluding, government give back programs like PPP or both Australia and Canada had similar programs that maybe not quite as generous, but still provided significant support to the entrepreneur community. The second one is inflation is real, and it's going to continue to challenge things. And I'll give you my case of why. Do not think that this is transitory. I mean, it was the dumbest thing anybody said recently is thinking that inflation is transitory. But there's some real reasons that I'm just appalled that the government doesn't seem to get their head around this issue, and they don't really have a lot of tools to change it. Or in the one rule that they probably could do to change it, you got a long way to go to get people aligned around it. And it's really because of this next bullet. The labor shortage is permanent. I'll show you some of the data charts that show we ran out of labor in the fall of 2019. Now, it was masked. We would have been seeing essentially what we're seeing today would have happened no matter what. No matter if COVID wouldn't have happened. We would be in the same shortage of resources, potentially same supply chain disruptions, based on how much of those supply chain disruptions are real versus versus initiated, by forces in the marketplace to create some disruptions. But, there were cracks in the system long before this. COVID certainly, threw a wrench in some things, but the labor shortage, it hit before COVID. And it's going to be there, until we start to learn how to 3D print humans. Supply chain issues, are going to continue. All the people that I follow that seem to have a pretty good track record in supply chain predictions, we're still looking at 6 to 9 months minimum, could be at least into the next year. And with other potential things happening in the world at the moment, it could be quite a while. The M&A market, though, continues to be strong and hot as ever. I mean, we're seeing phenomenal multipliers, for companies that, especially if you got any kind of hint of recurring revenue or super highly sticky customers, a profitable business that doesn't need a vast amount of labor, to marshal resources to be successful. Those are ones that the money just is gravitating to, and there's still just tons of cash looking for a place to go. Stock market, just as a commentary, I get asked this question all the time. I mean, you can't justify a 30 price to earnings ratio, but until there's a bond market to invest in, there's no alternative to the public market. And so every week with 401k contributions going into the marketplace, mutual fund managers have to buy the least ugly stock. And so every week it goes down, every week it goes back up, and it goes back down, and it goes right back up. And it's just the cycle, that we're in. Yeah, fundamentally you can't justify it, but until there's an alternative investment, it's kind of a market unto itself. But here's the thing, that this is a group of entrepreneurs on this call. If you can find a way to meet the current unmet need, and we're heading head on into a marketplace that is growing in the world of unmet needs. And this is, I start the Simple Numbers 2.0 book with the 3 simple rules of business success: is figure out what the market needs, find a way to do it profitably, and then does that profit, get you to a 50% return on invested capital. And so then if you check all those 3 boxes, you just go tell the market about it and make it happen. But the challenge is we don't focus enough on what is the unmet need of the market. We're trying to sell them what we do, but we're not listening close enough to figure out what is it that they actually need. And survey after survey tells you that the market doesn't tell you that. You have to discern it. And the best of you out there that are entrepreneurs that have run successful scaling businesses, you have an ability to read all the tea leaves of the marketplace and discern what is it that the market needs, so that you're largely selling drugs, to the marketplace. And so really from that standpoint, what you're trying to do is find that need. And then the challenge that we have right now is, can you source it? So I'm going to tell you the 2 levers that have changed for the foreseeable future that we've never seen in the business marketplace. Number 1, your employees now have leverage over you. I mean, think about it. I mean, when is the last time that you didn't have some sway over access of labor to be able to attract? Now, granted, there's some jobs that are dirty and hard to attract and all those kind of things. But really, at the end of the day, I mean, when was, really right now, we're walking on eggshells with employees about not being as direct in corrective activities and those things, because we're afraid to lose them. And if I lose them, I don't have somebody there's nobody sitting on the bench to go hire them. Many of us have really dropped our employee screening processes to really filter through, get people through quickly. I mean, the story that I'm hearing across the marketplace, as much as this community loves top grading and all those things, but people are abandoning top grading in droves because it takes too long. And I'm afraid I'm not going to get the candidate to say yes, because they got other alternatives of somebody that, I mean, it's like we're negotiating with a free agent, in the winter leagues for baseball. And who's going to get that person? And so that's the marketplace that we're in, folks. And you got to adapt to it. And it doesn't mean that you give up on principles. I think even more so is the time that you push to, to really hold people accountable to because good employees want to work around other good employees. But it is a dangerous time, for all of us to be able to do it. And most of you are sitting in a situation today that I would say, if we actually did a poll of the group, I would say 80+% of you have no problem with sales right now. Maybe even more, maybe even 100% of you don't have a problem with sales. You have a problem with execution. You can't get stuff out the door. You can't grow other than raising your prices, which certainly you need to do and stay relevant to that. And we'll talk about those techniques. But realistically right now, throughput is a problem. And probably the most common recurring themes that we see in our practice right now is we got people with $10 million of capacity and they're getting $8 million through the keyhole. They can't get to that next 2 million that gets them to profitability and sustainability, that it's either this material didn't show up or this employee didn't make it and we can't hire that shift, and we need to add a second shift, and we're losing people to getting poached by competitors. It's a real challenge. And so you gotta look at it and say, okay, what is my plan to deal with this? And it's not, and I was telling Eugene before everybody got on, I said, this is a marketplace that has a lot of crosswinds right now because it's not a universal thing. And so those of you that are in business, those of you that coach businesses, you got to look at and you got to be able to kind of interpret, to kind of use a golf analogy. I'm playing the 12th hole at Augusta. and the flag's going one way, but the wind's really going another, up high. And I've got to be able to read the conditions and say, which ones apply to me versus which ones really apply, to everybody else in the marketplace. And I'm misapplying a principle that, that really doesn't apply. And I've got to be able to read that better, in that marketplace, to really kind of guide people, in the right direction. So let's look at some of those things in terms of what the data is saying. So number one is, be careful in terms of what you hear in government statistical data is the first thing. This is our 100 company model that we have access to of our client data. And so one of the nice things that in the way that we work, we have a simple numbers format that, we talk about in the books. We see everybody's data exactly the same way. And so in those circumstances, it makes it easy for us to take that data, aggregate it, and then look at it in a model. And so we decided, after I did the research for the second book, we decided to keep that model going. And so now we've got it up to 100 companies that we'll update every quarter or so, and to just get a read on what the market is telling us. Well, this is what the government statistics from 2014 to 2019, roughly somewhere in the 3 to 4% GDP growth. Here's what our model said. It was 20% growth in 2014. It was 14% growth in 15. It was 15% growth in 16. It was 23% in 17 and 18, and it was 8% in 19. Now, other than 19, now, I got news for you. There's a Democrat in the White House here, and there's a Republican in the White House here. And, realistically, yeah, I mean, you had the first 2 years under Trump's administration, the people in the White House take way too much credit and way too much blame. It really isn't about them. Now, they can do some things to affect business. I get it. But at the end of the day, business is business, and entrepreneurs go find a way to make it happen. No matter, just tell us what the rules are, and we'll figure it out. In most, now you got some targeted industries, that might be affected, but in general, business finds a way. The thing that most people don't realize is this data point right here. This is the one that's telling you that that's where we hit the wall, and it wasn't for lack of demand. It was for lack of ability to get things done. And largely, the vast majority of the economy, has become very much a service-based economy, requires a lot of labor. And even the economy of stuff still requires labor to get it done. And some of that labor is not very exciting and not very attractive, to get people, to come work with it. Now, going to COVID, government statistics said we were down like 3%. The reality is, no, actually, this number was revised later. It's actually 6%. You'll see on the model here in a second. Government said we're about 7% growth right now. Our model says actually 26%. So these were actually October data points that I had, back earlier in the year. So this is the actual data through December of the 100 companies. So this is about $1.1 billion of revenue. So I feel like it's $1.1 billion of activity from 100 companies, a little over $10 million average, but it's got some small companies. It's got some, under $100 million companies, up there. So it's a blend of all those. In reading the tea leaves of the data, this is what it tells us. Number one, we're at 6% growth of 2020 over 19. We're at 26% growth in revenue over 2020. Now, those are dollars. Now, the problem with gross domestic product or GDP is it's an output measure. It's not really, we measure it in dollars, but if you were really being a purist in economic terms, you would actually learn to measure output. Well, how do you measure output in an economy of services and labor? And as we always like to remind people, the reason why we do our simple numbers format here of this structure of revenue minus COGS, which has no labor in it, and then keep direct labor separate is, our philosophy is really straightforward. Never mix labor with something that's not labor, because labor is the only cost that comes to work every day with an attitude. It has some good days and it has some bad days. And it can be good people that are poorly managed. It can be well-managed bad people who just can't deliver, what you need because you can't get access to the labor. So those things are hard to measure, from that standpoint. My sense is from my consulting team, and we do these calls every day, month in and month out, I would probably tell you at least 15% of that 26, maybe even up to 20%, but probably at least 15 of that 26% growth is inflation. Because every call we're talking to clients about pricing. Have you pushed it? Have you pushed it? Have you pushed it? And I can tell you without fail, of all the we probably got about 250 active consulting clients that we do these calls with. I don't have a story yet of somebody that raised their price and came back and said, that didn't work. Everybody stopped doing business with us. Hadn't happened yet. Now not to say it can't, but for the vast majority of these people we're talking to, they just have not pushed pricing enough, and they're scared. They're scared to death. But here's what the data is telling us. So we've had fairly consistent gross margin, but a little bit of weakness rolling 12, through this year. So we're about a percentage point down from last year, but still equal with 2019. But here's what the rolling 3 tells us. The rolling 3 is the last 3 months of the year, and it's telling us warning sign, because this is the prediction of the future. And we're already 3% off, from that number. And that 3% is telling us that this cost of goods sold, which is, there's more of a delay effect of inflation hit coming to you if you have any appreciable amount of COGS. Because those manufacturers and product producers are really slow to adjust their pricing, much more so than a services entity that you start paying somebody more, you intuitively know I got to raise the price of what I pay for that person to recover what I had to give them in a raise. But the people that mix all this stuff in to get to a loaded product cost, they're very bad about taking way too long to adjust pricing, because they come at it also from a flawed technique of it's a cost buildup pricing. And it's like, no, cost buildup is needed to know, am I making a profit or not? But cost buildup isn't exactly how price is determined. Price is determined based on what the market is willing to pay for something that may or may not be in sufficient quantity. And so therefore, I should be charging a market price relative to the conditions of the market, not relevant to the cost of that item. It just has to be enough to make sure I don't lose money to sell that item. But as we talk about some common errors in pricing strategy, the worst thing in the world is to start your process to determine price by looking at cost. It's just the dumbest idea you could ever come up with, and you got to stay away from it. Secondarily, now here's the other side. Now, pretty much we did good. This labor efficiency ratio, 271 for 20 and 21. That's gross margin divided by direct labor. So that's telling you the pure output. Now, the thing is, my rolling 3, though, is giving me flashing red light. We're down to 260. And if I showed you the month of this model, it would actually show you it was down in the 240s for the month of December. So we're in this headed down decline that when you look at, I didn't produce enough gross margin for that labor. This is the power of what trending data and rolling in labor efficiency ratios will tell you is, am I getting better? Am I getting worse? And is my problem productivity of the labor, or is it my pricing? It's one of the two, and probably both in that process. And so you have to look at it. And this gives you that feedback mechanism that as you're looking at your data, in your business, of going, well, what are the indicators that's telling me that my people are producing everything, that they're supposed to be doing? And I'll just share with you, this is really where we've really pushed hard with a lot of our clients to improve their productivity lately, of really pushing through to say, what is this week? So you start the month and say, what's my gross margin target for the month? Not the revenue target. What's my gross margin target? And then 1 week into it, where do we stand? We got 3 weeks to go to do something about it. 2 weeks in, where do we stand? We got 2 weeks to go to do something about it. 3 weeks in, where do we stand? We got 1 week to do something about it. Did you get enough stuff across the finish line at the end of the month that could have gotten done? And I guarantee you, if I polled everybody on this call, I said, all right, I'm going to ask you a really easy question. Did you get everything done in the month of February that could have gotten done and billed in the month of February? And for 99% of you, if not 100% of you, the answer is no. Well, where did that thing that could have gotten done, if you had managed a little better, if you pushed a little harder, if you'd been a little more focused, well, it's now blocking March's production. Yeah, you sold it, but I got plenty of clients right now that have the biggest sales backlogs in the history of their business. That ain't winning them, putting any bread on the table. They can't get it out the door, for one constriction or another. And that's really what you've got to pay attention to. Notice this, so 26% revenue increase, 22% increase in direct labor. So that's telling you, these two numbers, labor and revenue, are pretty much tied at the hip. And I'll show you another chart here in a second. 15% increase in management labor. So management labor has not been rising as much as direct labor. So this is very much an inflationary pressure of the lower end of the wage market, not the higher end of the wage market. Now, what does that tell you? There's a whiplash coming, because there's just a natural gapping that if I raise the lowest wage jobs in the marketplace, there has to be spacing between that job and what everybody else makes. And it may not happen immediately, but it will happen. And so I got news for you. You're going to see continued pressure, especially on your executive wages, or else somebody's going to poach them. I mean, it's a pretty active labor market. And if those people if they're any good, they got people knocking on their door saying, hey, come on over here. I got a nice pay package for you, because I need you. And those people aren't staying relevant. They're not keeping up. They're not, they're not adjusting your wage until they got a gun stuck to their head. And so just keep in mind that those things are certainly challenging. Here's the other thing on profitability. So as I said, we did better. And this net operating income does not have any PPP funds in it. So this is pure operating profit. So these companies were actually more profitable during COVID. My contention is, from our calls with our clients, is people were scared enough in that April to June timeframe that they actually trimmed unnecessary labor and didn't add the lower performing labor back. And the reimbursement process for PPP was flexible enough that 10% of employees that really were the low producers that I really could get by without, that's what people kind of culled. And then those people had plenty of government unemployment money, flowing into the system to keep them going. And then now, if they want to work, the employment market is so in hot demand. I mean, they're able to find jobs. So, but here's the future of telling us where the warning sign is. So we're now from 8.79, we're down to 6.7. And so that's really, hurting. So this is kind of the rolling 12 chart that I want to show you. And so back here, up until this point of October of 2019, we were a revenue-led, process. So when remember I showed you up here, the marketplace, we were growing, and then in the year of 2019 we hit that speed bump. Well, that's what's happening here. Is revenue increases, you backfill with labor. Revenue increases, you backfill with labor, because the labor was generally available. You could get it. We ran out right here. If you go back and look at the fourth quarter unemployment statistics, we were at historic unemployment lows in the U.S. in the fall of 2019. Then you muddle through this period of COVID, and then the first thing that shoots out coming out of COVID is labor leads the way. So as labor is going up, it's now pulling revenue up. I'm paying more for labor, I got to raise my prices. I'm paying more for labor, I got to raise my prices. I'm paying more for labor, I got to raise my prices. And that's really where we're at. And then notice, this is the more important part. This is net operating income. The yellow line here is we hit this wall right here, to where prices are rising faster than we're working in the recovery of that since about the last half of 21. And so we're watching it carefully. I mean, granted, like I said, in our case, I mean, we're pushing hard on our clients to keep pushing prices. And everybody's uncomfortable with it. And at what point does somebody say no? But story after story that we're hearing of people that are getting hit with increased cost after they've already bid something, and then they're having to eat it and they can't recover it. And that those misses are what's hitting you here. So let's talk about what do you do about it. So essentially, don't forget the laws of supply and demand. I mean, unless we have lockdowns or price controls, and Lord help us if they try to do price controls. But as long as demand exceeds supply, prices are going to go up. And tell me, name one thing that's in excess supply right now. I'd have a hard time thinking of it. Store shelves still aren't plentiful. Not back to full product availability in some markets. I was driving to church Sunday morning and wanted to stop by Hardee's and grab a biscuit on the way, and the line was around the drive-through was around the building, so I decided I was going to walk in. Door was locked. Nope, no indoor service. Went across the street to Burger King. Their line wasn't that long. Come to find out, line wasn't long because they weren't open. They didn't have enough employees show up for work that day. This is third world economy stuff that shouldn't be happening, but it's happening. And all of us have stories of time and time again, that people aren't able to get something done, because of these things. Here's the reason why no help is coming anytime soon, folks. We're below replacement birth rate, 1.8 in 2021. It's probably trending more towards 1.7. There's no 20-year crop of humans coming to fix this. And last time I checked, we've kind of been inconsistent to brain damaged in our immigration policies that we can't get either side. Neither party within their own party can agree to it, much less find some common ground that says, you know what, we kind of need some people to help us. And it kind of needs to be the right people. Now, a lot of you guys have been really pushing for international labor. And I would tell you that, for anybody who can find a job that can be sourced in, either Eastern Europe, the Philippines, India, Central and South America. We've got clients that are tapping all of those markets. One of our clients is a company called Outsourced Doers. They're based out of Australia, but they place virtual assistants. Most of their customers are actually in the U.S. Their demand is off the chart, but they have a really good process to find plenty of people in the Philippines, to do those virtual assistant duties. And what they're finding is not only are these people better at the job, but they stay longer than what we're seeing in U.S. Now, the thing is, if you're making a latte at Starbucks, let's see, I can't have somebody in Argentina making that. Doesn't work that way. And so those of us that have to have physical presence, of labor, you're gonna have some challenges. But if you can outsource something and probably find a way, I would probably tell you, that I'd be investigating that, because it's less of a cost issue as it is. I actually need a consistent employee that's going to show up and do their job well every day. And that's just, we're down to that level, in the labor marketplace that we just can't get them. So if you're going to win at labor, you've got to be able to shoot a little bit lower in skill set than what you immediately need. And if you can rapidly develop task-specific training to get that person from where they are to where you need them to be, you're going to win. You can charge a premium for that. You can be extremely profitable. You're going to be tested. This is a community. If you're on this call, you have been indoctrinated into the essential nature of core values, core purpose, and strong culture. This is where you're going to get tested of whether or not it really works. Now, And I will tell you, in the past, we've sold these ideas of core values, core purpose, strong culture as being a way to pay 20% less than the market. No, I don't think you're going to be able to get away with that, but it will allow you to actually keep the good people, but you'll still have to pay them a market wage. But I don't think you're going to, the numbers are too diverse to where I don't know that. I mean, there's going to be some anecdotal evidences of it, but I don't think it's going to be widespread. But you need to have it now more than ever just to get the good labor and pay them a fair wage. And I'm telling you, you can price for that capability. You should be able to recover it in your pricing. And to the other side of it, if you've got to have flexibility in pricing, you've got to be constantly looking at pricing monthly, quarterly. You cannot wait once a year to adjust pricing. You cannot have multi-year pricing agreements unless you just really push the edge of what you put out there in terms of trying to out estimate it, and get away with it. But that's going to be really, really hard to do. I really worry about the industries that, if a lot of the medical industries that are based on insurance billing, you don't get to choose what you charge. And so in a high inflationary marketplace, you've got to be really, really careful and you got to work the insurance companies to make sure that they know how much your costs are going up. Now, early evidence, some of the payers are actually being pretty responsive to this, but some are lagging. But in a model where you don't control the price in a highly inflationary cost environment, you got some challenges, and you got to stay on top of it, from that standpoint. If you cannot wait to train lower cost labor, you're going to have a problem. If you have to deal with long-term pricing agreements or anything that talks about consumer price index is a joke. I mean, it is nowhere close to what the true need of the recovery. If you rely on the H-2B visa program, great program when it's available, but the government plays political football with it. And sometimes you get workers and sometimes you don't. And when you don't get workers, you just have a massive reduction in terms of sales. I mean, if the risk is if the government comes out with one of those programs, it's great. Just understand that any program is subject to the political whims of it getting pulled out from under you. And so, so just be prepared. But if we had consistency of programs like that, you could create a much more stable, service environment. And those programs pay really well. I mean, they're paying a market wage, and it's a very good wage, for those workers. And those workers are able to send that money back home, and they're able to make in 9 months, what it would take them 3 years to make, back home. If you rely on the bottom end of the wage market, though, in that $15 an hour, you've got to be able to push those prices through. And I'll give you a good data point. I mean, I got a plastic extrusion manufacturer in South Georgia. He was paying $13 an hour for line workers and had pretty good access to them in 2019. And today he's paying 18 to 20, and he can't fill up his second shift right now, even at 18 to $20 an hour, paying an extra $2 shift diff, for that second shift, because people don't want to work second shift. And they get to pick because they have other options. So sounds great, but it's hard to make happen. So this picture should scare the bejeebies out of you. So in 2020, this was the picture of the world of where China was the dominant trade partner. Here's where it's at in 2020. And we don't have a lot of leverage, and you can make an argument if you look at some of the people in the logistics part of the world, that talks about this. I mean, some of the supply chain disruption might be a little intentional. Some of it's caused by market conditions, no doubt. But it really has exposed the fact that we are at risk, with so much stuff, trying to move to this just-in-time inventory at the least amount of cost, not necessarily the best strategy. And so there's a lot of things that we need to get made near shore a lot sooner that can't happen fast enough, especially microchips and some of those things. But anyway, I mean, these are things that if you are you need to do a review of your business in terms of what the China influence is and say, is there an alternative? And I need to be developing some of those networks of alternatives, as fast as possible. So, with our remaining time, let's go through these because these are the most common pricing errors. And I told you, Gene, I'll send out a PDF of this deck because there's a couple of, after this, there's a service business pricing strategy, a product sales pricing strategy, and a manufacturer pricing strategy. So we won't have time, in the time we have to go through those 3 bullet points, but they're pretty self-explanatory. But here's the common problems that we see. Number one, pricing bias. We've done case after case of doing a new planning session for a client to go through their last 3 years of data. I had one that they had exactly the same contribution margin percentage to revenue for 3 consecutive years. And I said, well, I'll give you an A+ for consistency, and I'll give you an F for pricing. I said, there's no way doing $17 million a year that you've had exactly the same margin for 3 consecutive years. And you've left money on the table somewhere. And they hung their head and they said, well, yeah, we just found out we were $1 million short of the nearest bidder on the last project we won. And it was because of the second bullet. They would take the cost, add overhead, add profit. That's the price. No, that is not the way you price. And I said, the best technique I can tell you is before you start anything of any project of any size, you write down somewhere and say, how much is the customer willing to pay for this? What's their need? What is their, what were they willing to pay? And I need to put that number somewhere before I start getting into the details. Because once I get into the cost, I cannot get my brain all the way up to market value. Now, if I write that number down and cost plus all of those things leads to a number that's higher than what I thought the market, would bear, then I got to go back to that customer and do some selling to say, listen, I know you'd like to have this for 50,000, but it really needs to be 75. And it's exactly what the guy who built my pool, I was hoping to get it for about 80 grand. $150,000 later, then I've got a really nice pool. But I got a really nice pool because he did a good job of telling me that that $150,000 pool is really what I wanted, not the 80,000. So once again, you understand, but there again, if I wrote down 150 and the cost buildup came to 80 and I know they'll pay 150, why don't you charge them 150? Especially in a constricted environment with limited access to labor, limited access to goods, and schedule. Because here's the thing that happens in just about any bidding environment that you go into right now. Can you do it? When can you do it? Oh, how much is that going to be? Price is well down the list in terms of, now, it's got to be somewhat within reason, but it's not the number one thing on the list. And if you have the ability to be quick and you leave premium gaps in your scheduling of process and production to get to those high value customers, because not every customer is equal. I got news for you. If you think they are, you're wrong. There are some customers that are more valuable than others, and I need to take care of those, differently. And if you think differently, that's fine. But you won't be as profitable. And you've got to look at those high value customers and slot them in and take care of them. The idea of only passing through cost increases, that cost did not happen on its own. It took people to handle it. It took extra handling to kind of deal with it. If you don't get the margin add to that cost increase, you're getting further behind. You've got to find a way, use whatever, Jedi mind technique you can to convince the customer, but you got to get margin on top of that cost increase. Contract negotiation errors of talking yourself into, this will be over. I can give them a 2-year price. I wouldn't be giving anybody a 2-year price right now unless it was just so high. I'd still be worried about it. Billing by the hour is my favorite, whipping horse. If you bill by the hour, there's only 2 possible outcomes. I either gave away my expertise or I charged for my ignorance. That's the only 2 possibilities in billing by the hour. Why do people bill by the hour? laziness. People bill by the hour because they're not skilled at scoping. So you got to put the effort into scope and find a way to do scoping that isn't so labor intensive. But and I got to deal with the statisticals. I might miss it high or low on one or the other, but the averages work out. I mean, you can get there. And then secondly, you don't bill by the hour because you can't manage to the outcome. And if you can scope and you can manage to the outcome, you will be far more profitable billing on a fixed price basis than billing on an hourly basis. Granted, there's a handful of things I get it that probably have to be hourly, and we begrudgingly do a few of those as little as possible. But it really is about defend your value, go do it, manage to the outcome. The other one that's really kind of interesting is this idea of, I got news for you. We price in a perfect world. If everything goes perfectly, here's the price. Well, you know what? Coming out of COVID with supply chain issues and all kinds of disruption in the world, there is this kind of conflict over in Europe with Ukraine. A lot of uncertainty, a lot of inefficiency. And you have to, this is a time frame in the marketplace that you have to price in the inefficiencies of the market. We've got clients in the product world that are, they have never had to store or pay storage fees for things coming into the port. Well, now they do. They've got fuel excess charges, that they weren't planning in on. And so once again, in your pricing strategy, you have to look at it and say, am I going to have to hire temp labor that's not very efficient and it's expensive? Okay, well, I got to price that in. Am I going to have storage fees on my products? Am I going to have time delays? All of those things. And you've got to start pricing those things in, because you know what? Your competitors have the same inefficiencies. They have the same challenges, and you've got to price those in, in that, from that idea. And really, you've got to be careful, this next one, of incorrectly equating volume, to grow, volume increases with the increase in price. That doesn't help you. A price increase is an immediate impact to your bottom line, versus if I just sell more, it's only that margin impact. And if that margin's squirrely, I don't know what I'm getting in that. And then the last piece I'll leave, and then we'll do some Q&A here. This is a time frame where, if you got to give a bid and 9 months later you're delivering the product or service or project, you may have to unbundle the cost of goods from the cost of services, because I can have each one of them could move in a different fashion from the time I bid it to the time I do it. And if I want some ability to have cost recovery, I may not be able to kind of create that package price that kind of hides where my extra value is. And so just throw that out there as an idea that is different, because a lot of people like to sell bundled services with goods. But realistically, we're in a time frame where I don't think you have to be shy about calculating the value of what your service is. And I think a lot of people, would try to hide, the value of a service in something with a product. And I think sometimes you're fine to kind of unbundle those things. All right, so with that, I've pushed you kind of right to the edge of your time. So Eugene, we'll open it up for some Q&A if you want to moderate that.
Sure. We did just get a question in. So again, just a reminder, if you do have questions, please use the chat function. We had a question here that was posed. What is your opinion on charging a fuel surcharge if I am not a freight company, but I have mobile vehicles on the road every day?
Oh, absolutely. I mean, there again, what you're looking for is a technique that says, what is it that psychologically gets the customer to understand what my temporary status is? And so once again, a fuel surcharge that's a temporary item is saying this won't be a permanent price increase in the item. Because if you change the price of the item, chances are you're not lowering the price. I'm not saying that you couldn't. But if you do a fuel surcharge, you're saying this is a temporary condition that I need to be able to recover it, from you know, from the marketplace. And so, you know, when that condition is, you know, subsides, then I can remove it. And so I can see, you know, customers are going to understand that. And so I don't have a problem with that at all.
Questions again, please use the chat. Greg, one of the questions that I would have is, you know, just as an example, we're in the software as a service business. And so we really do price the same for everyone. You're a customer, you're using our software as a service. And so, you know, and when you talk about constantly changing prices, whether by the month, by the quarter, or, you know,
well, you think you price, well, you may price it for everyone the same way, but you don't have to price it the same for everyone. So let's think about that. Software as a service. Now, do you sell it as a monthly service? Do you offer quarterly? Do you offer semi-annual pricing? Do you have to offer annual pricing?
Yeah, no, absolutely. You have
those are different prices.
You're right. You have you know, discounted rates for an annual subscription, you know, a monthly rate that isn't discounted. But my question was going to be that, you know, customers tend to talk to one another sometimes. You know, people who use your services or buy products from you tend to speak to one another. And so just how do you sort of handle what, if any, blowback you might get from people saying, well, hey, you charge John X, why are you charging me Y?
Well, I mean, you're you know, one, if you're selling a very discrete item such as software, I mean, so, you know, each customer is buying exactly the same thing, you know, but there again, did you buy it? Did you buy it at the same time? You know, did you buy it? Did you pay in advance, and all those things? And so those are fairly easy to determine. Let me kind of pose this to you. And so you're selling the same service, but the thing is, do you want it this afternoon? Do you want it tomorrow? Do you want it next week? Or do you want it next month? Now I'm selling exactly the same thing. And so let's say you go down to Lowe's and I need to replace my front door. And I'm buying, this front door has a price on it that's a fixed, includes installation. I'm gonna pay, you know, $1,500, you know, for something to be installed next month. Oh, your door, somebody busted in your door, you need it tomorrow. Yeah, that's gonna be $2,000.
Yep.
And once again, and this is where the laziness of pricing. So I'll give you the best story ever. So in my EO forum in Atlanta, we had an event at the Georgia Dome when Arthur Blank bought the Falcons. And so he was taking us around the stadium, telling us the story about the first day after he bought the team. And he was talking to the ticket manager. And he touring the stadium, and ticket manager, he pointed down to the front row seats on the 50-yard line. He says, how much are those tickets? And I, you know, $150, whatever the number was at the time. And he says, oh, okay. No, how much? He pointed to the nosebleed seats up in the corner. He says, how much are those? Well, $150. He looks at him and says, why is that? And he says, well, it's a lot easier for us to just charge one price for all the seats. Needless to say, that guy lost his job like, you know, 2 minutes later and was replaced because he looked at price as an operational efficiency issue rather than a value recovery issue. And I think the common error, regardless of the current circumstances that we're in, we many times are leaving that on the table. I did a Skew analysis for one of our large product clients up in New York, you know, a couple of months ago. And we just stack ranked all of their product, all their SKUs from the most margin created SKUs down to the smallest, but I'm just focused on the top 25. And we saw, you know, easily 10% margin variation of half of the items. And I just pointed to those items and said, well, you know, this item you're getting 71% margin, and this item you're getting 61. Is there any reason for that? Nope. Just missed it. I mean, this left 10% margin on the table for millions of dollars of goods that wouldn't have affected the market, what the market paid whatsoever, just because it was oversight. Too much stuff, too much, you know, they didn't have a process and a strategy to create vision of it to create this consistency and strategy. And this is really where, the coaches that are on the call, I mean, this is why we love working with coaches, because they can really help, those companies work through those and hold them accountable, because these are things that you don't flip a switch. And I mean, some actually you can do overnight, but sometimes it takes a little bit of effort. But it really is that consistency of understanding, why do I charge what I charge, and am I leaving money on the table?
Greg, we're almost to the hour. I don't know if you have a few minutes to answer a few more questions.
Sure. Yeah, I'm good.
Chip asked, we're looking at rising interest rates and inverting yield curve, increasing the chances of a recession in the next 18 or more months. How much of an effect will that have on the labor market?
None. Not enough people, period. I mean, it's going to affect it's going to affect some purchases of goods. So here's really what I think. And so as interest rates rise, they're going to back up. They're going to back the truck up from this within 2 or 3 months, because what they're going to see as mortgage refinancing will go to nothing, and people will stop. I mean, one of the things that's fueling a lot of the consumer cash that's out there, people refining their home mortgages. We've got some clients in the home mortgage space. I mean, and they just have been asking themselves, when is this going to stop? Well, as long as the increasing values of homes are there and interest rates stay in that 3%-ish range, people will constantly refi and recap, their mortgage and take that money off the table and continue their spending ways. And I think what happens is when you see, the mortgage market we're now seeing probably 4%, in most cases on mortgages, and it's going to slow the refi market to a dribble. Now the home purchase market, we're still behind, and that will continue for a while. You still got a lot of committed building projects that they're already committed. They're going to happen. In that regard. I mean, and really, to be quite honest, I mean, it shouldn't keep somebody from spending money just because a mortgage is 4% instead of 3%. Now, if it gets to 5%, you start to slow some things down. I think what you're going to see, though, is some inconsistencies of consumer behavior, because they're not comfortable with the current environment. They're seeing gas prices up. They're seeing mortgage rates up. Those are two key indicators that causes people to go, oh, wait a minute, and they kind of paralyzed for a month or two. But then they start to realize, oh, wait a minute, I got a raise from my employer. I changed jobs and got a nice big raise and a bonus, to move jobs. And well, I actually have money. I actually am not broke, and I can actually afford it. And the cycle continues. So it's not going to be smooth. It's going to be kind of jerky, but until we have excess labor, you're not going to, you might see flat. You might even see a slight decline. And here's the problem with a slight decline, though. We won't know it because the dollars will be bigger. I mean, there was a nice news thing that came out. I was watching that, this business newscaster was talking about retail sales was up in December 7.5% year over year. And the analyst she was talking to kind of quietly, yeah, but units were down. I mean, you could almost argue we may be in a recession if we could measure it at right now, because dollars are up, but it's inflationary dollars. When you don't have any more bodies to push stuff through the system, are we producing more? I don't know. I mean, we may actually already be there, but the dollars are bigger.
Question was posed: when you have your staff making pricing decisions every day, do you have any ideas on how to educate your staff to price in this current environment, when the staff themselves might not be very financially literate, and taking into consideration that the staff might think that the business or the organization is ripping the customers off by raising prices?
Yeah, I mean, I've run into that. I mean, I had a call yesterday with one of my retail clients, and I mean, their COO, I mean, this is not just the staff. I mean, this is the COO was pushing back on the price increases. And I said, listen, I mean, of the most recent price increase, does anybody come in and complain? No. It says, you haven't raised prices enough. I mean, until one person complains, you're leaving money on the table. And it's like, what are you thinking here? And because, everywhere we turn, we know our employees, we want to be able to pay our employees more, and they're trying to be proactive to get their employee pay up without their employees having to have a mutiny before they raise their pay, which is kind of a good idea, I think, in most cases. So really, I thought the owner of the business, I thought she had a really great point. She said, I want them to know that, we're keeping margins, to where they need to be so that we can continue to keep their pay progressing, to the current economic conditions that they have to live in. And as long as you show that and demonstrate it, I think that's the best argument that I've seen.
All right, Greg, one more question. We were asked by somebody who has a service business where about half of their revenue is billed by the hour. They have labored and worked hard to figure out how to go to a fixed rate, but they can't figure out how to do it because they've got, an exceedingly large number of existing clients that are on hourly. And so where do they go to sort of search for a solution? Do they just start with any new clients who come on, move to fixed?
Yeah, so there's two ways to attack that, and you gotta have a two-pronged attack. Number one is, yes, the easiest people to sell on the new process is a new customer.
Right.
And so that's the best place to have market validation, because the old customer, has it's imprinted in your brain as to how they want to work, and they're comfortable with that. The other one is we call this the pizza lunch discovery process. And so get your techs together, buy pizza, and put up some Post-it notes and markers on the wall, and you have a discussion to say, what are the 20 most common requests that we get from our customers? So let's just line them all out that we bill by the hour for. Now, what if we were going to charge, if we were going to say, we're going to take hours off the table, every time you ask us to do this, here's what we should charge for that. And we can manage to that outcome. And that's the way to attack it, is you find all of the repeating elements. Now, what it means is I've created a narrow focus of what I'm going to bill fixed price for this thing, because I don't have to track hours for that piece. And if you ask us to do other things than that, we'll bill you by the hour for those. But when you ask us to do this, it's X. And there's no discussion of hours, and the customer should be happy with that because they're not worried about how long we're there. And a customer who wants you to show up for an hour, I'm sorry, in today's world of gas, human travel time to and from, a job site, I think everybody's kind of accepted the fact that there's a minimum number that you got to get. I mean, you call an electrician. I mean, there is no matter what they do, you're going to pay $350, $400, $500, depending on the market, just to have somebody show up. And if they can handle what the problem is within that time frame, you're great. And if they can't, they're going to give you a quote for the next thing that they're going to do if you want them to do it.
Great. Greg, I think that's really all the questions that we had, and we're now 6 minutes over. So I want to thank everybody for attending today's Coach webinar. A huge thank you to Greg for a great presentation. Obviously, you can learn more about him by visiting the website for his firm at cricpa.com. As always, we encourage you to use the Align software if this will help you sort of put some strategic planning and execution around pricing increases or dealing with inflation in your business. So don't hesitate to reach out to us if we can be of some assistance. Thanks again. We hope that you will join us for our next Coach webinar. Till then, we hope you have a great day, and thanks so much, Greg.
Yeah, appreciate it. Thank you.
Take care.